Welcome to Morningstar. I'm Larissa Fernand, and with me today is someone I've known for a very, very long time, Devina Mehra, the Chairperson and Managing Director of First Global. Devina, welcome and thank you so much for your time.
Thanks, Larissa, for having me. Always a pleasure to talk to you.
Lovely. So, Devina, this month is really special for you because you complete 3 decades since you got into equity research. I think it was August 1993 when you quit Citibank. So there's two questions I have based on this. Anything about investing that you once believed that you no longer believed, and what has stayed constant?
Yes, I mean, the August 1993 is when I resigned from Citibank. Actually started on October 1 after the notice period. As far as investing is concerned, this was a completely new field for me. And in fact, for India itself, formal securities research did not exist prior to that. So this was a discovery period for me, as well as I would say for the entire market. I did know companies to some extent because I was a credit analyst in Citibank prior to this. So I had some understanding of industries and companies. And in some senses, it was a very good training because it trained you to look for risks. Because as a banker, you do not participate in the upside, you only participate in the downside. So that's the part you are concerned with. Whereas you go straight into equity, it is all very rara, everything is with rosy spectacles. So that was good that I had that training of looking at risk. And beyond that, it all evolved because at the beginning, when I started off, did not even have that clear an understanding of discounted cash flows or cash flows themselves. I mean, you did know how to calculate cash flows, but the importance of that, or for that matter, return ratios. So in the beginning, I even used to sometimes ask large foreign institutional clients that recommend books to really understand this. So it was a process of discovery, and then you start adding on more nuances, and later on devised ratios of my own and all that. But beyond that, also really understanding more how important it is to have the mental discipline, the biases, the random noise in decision making. So those were all things step by step it started to get added on, and then later on, of course, to put it all into a system, which is another step altogether to sort of codify your expertise.
So it's quite a bit of evolution then from the way you're talking. You evolved quite a bit as an investor.
Right.
Okay, so is there any investing truth that you hold which is not popular? Something that you believe that's not very popular in the investing community?
Oh, more than one, I would say. One, of course, is this thing of investing in your circle of competence. I would say that is a euphemism for comfort zone. So especially when you're managing other people's money, how you manage your own money is your business. But if you're managing other people's money, then if you understand only 2 or 3 or 4 sectors and you invest only in those, why should your investor be held to ransom to your expertise? Because the same things, no theme lasts forever, no geography, no asset class, no sector. So if you understand only FMCG and banks, what are you going to do when it is a commodity upcycle? I mean, just to give you an example. The other thing which people do not understand properly is the concept of probabilities. There is all this talk of high conviction and all that. I think that's complete nonsense because they're in markets and in life, there are known unknowns, there are unknown unknowns, and the outcomes is always a range of probabilities. You look at the most successful companies which have made a lot of money, Amazon, Apple, Tesla, all these at one point came within like hours literally of bankruptcy. So it's not as if that anybody buying that uh, always made a good decision, or somebody who refused to buy it or passed on that opportunity necessarily made a mistake. So you have to, because I mean, at that point, the probability of their going bust may have been higher than the actual path that happened. So don't get, which is something people don't understand, that the quality of the decision making is not the same as the quality of the outcome. This is another thing which people often don't understand. Another thing is that, people talk of subjective things, brand value, management quality. I believe ultimately anything that you are saying should come through in the numbers. That's what I teach the people who have trained under me, that if you're saying that this company has great brand value, where does it show up? Does it show up in better market share? Does it show up in better, more pricing power, in margins, somewhere on the balance sheet side? And you'd be surprised at what comes out. So, that's the other thing, that subjective things also eventually have to show up in numbers.
You're very conscious of risk, going by the way you talk. You place a lot of importance in it. In your out of investing life, so to speak, how does risk, are you very risk averse? Do you like to take risks?
Out of the investing life, the big risk, of course, was leaving a job and starting off as an entrepreneur. And that too in your 20s, at a time when neither was any capital available if you were starting up, and nor was, there was any great hype around becoming a business person or entrepreneur and leaving what was then considered the top job. So that would, I would say, would be the kind of most risky decision I took. I also took some unconventional decisions like going global. But it wasn't as if that was putting a great deal of your life on risk.
But you've never been afraid. You've never been afraid to be outside the consensus, right? You've often said that you're very comfortable stepping out of your comfort zone. What is the quality that you hold that enables you to do so?
I think some of it is innate, that whatever the inner strength you have. And strangely enough, the fact that I mean, looking back, I mean, I'm just being pop psychologist, that I did not have friends in school till class 4 or 5. One, because I was significantly younger than my classmates, and then topping the class and all that. So I was simply too different. And at that time, when you're 4 and your classmates are 6, the difference is too high. So whatever be the reason, from age 4, 5 till about 9, 10, I did not have friends in school. So maybe it never got ingrained in me to check whether something was acceptable to the group or what everyone else is doing. So, I maybe got used to just thinking on my own on what is logical, what makes sense. And maybe it is also my Pathan roots. My father always called himself a Pathan, and I met somebody who made a documentary on Pathans. And this is like one of their characteristics, that, they are not really bothered. I mean, it never occurs to them to think what is someone else thinking of their decision. And I think while I used to laugh at it, I think some of it came through to me.
So this is exactly what you once said, if I remember correctly, that you don't benchmark, whether it's in investing or academics, you set your own pace. You don't benchmark against someone else. So how do you define success? How do you measure success?
In terms of academics, etc., it was even now, I mean, whether you are first of all doing your best. So I should never at some stage, at a later stage, feel that the outcome was not good enough because I did not try hard enough. Because, I did not work hard enough. I did not, check everything as well as I should have. So, and if you don't benchmark, then you are not, not looking over your shoulder. So in my undergrad, for example, I got 88% and the next highest was 78%. Maybe if I'd been benchmarking, the difference wouldn't have been so much. And even today, if I look at our PMS and the next best, the difference is just about as big. So, I mean, now, of course, you are managing people's money. So first of all, I mean, this is a big responsibility. And therefore, first of all, you want to make sure you are doing the best and you are doing better than the benchmark. So you can't say that you're not looking at the benchmarks today at all or anything like that. But that is the thing. And as far as, not doing the conventional thing, I'll tell you, the PMS license we had for 20 years before we launched a product. Simply because I wanted to be sure I could do a good job, that when somebody entrusts their hard-earned money to me, I should not, make a mess of it, or not just make a mess. I don't want to do something where there is no replicability, there is, no foreseeability. I wanted it only when I could say with a reasonable amount of certainty that this is the type of outcome you will get. So that was definitely, a large part of the reason. So it didn't bother me that everybody else has started and that they will gather AUM, whereas you have not even started. That was not. I mean, my benchmark again was vis-a-vis the investor, not vis-a-vis what everybody else was doing. On the other hand, I went global when nobody dreamt it could be done. In fact, everybody but everyone I asked said that it can't be done. You cannot research sitting here. And even if you do, nobody is going to listen to you. Who are you? Nobody knows you in the US or UK or Europe. So that didn't bother me either. So whether you're first or much later, that was not the benchmark.
When you look at yourself as an investor, how do you fit in any sort of a spectrum? Are you value? Are you growth? Are you risk averse? How do you talk about yourself?
Okay, so two things. One, of course, the risk part is very much high up there. I mean, it may not have been that high up when I was managing my own money, because there you can take more risk. But when you are managing money professionally, that's number one, because investing is a loser's game. So anyone watching this, please Google Charles Ellis article, loser's game. Yeah, so that is the key, is that do not lose big money. You will win only if you don't lose. So that is the cornerstone of our philosophy. And we have like about 7, 8 different steps in the whole process to ensure that the risk remains contained. And every stress test, whether it was the COVID crash in March 20, where our India global products went down only 8 to 10%, whether it was the Russia-Ukraine war, it works. So risk is the thing. But I do not believe in this value and growth kind of silos. Because as I said, for one thing, no theme lasts forever. So you cannot be in one silo, because that's going to do well for some time and not do well another time. So just reason things from first principles. That is the key. That is the key, that like you must not take anything as conventional wisdom. Right from what is written in the textbooks. In 90s, when I started capital asset pricing model, efficient markets, this was being taught everywhere in University of Chicago onwards. But I said, let me look at the numbers. Does it come through? If markets are that efficient with no fresh information, why does a stock move 50% within a quarter? So was that price efficient, or is this price efficient? If I calculate beta for the stock in different time periods, it comes out to be totally different. So what is the beta of the stock? What number should I use? I mean, today people ask me that what are FII flows, and therefore what is the market? I said, like, have you ever looked at whether FII flow, there is even a correlation, let alone a causation between FII flows and the market movement? There is none. So I always look at data, not what everyone is talking about or what the narrative is. So those are definitely, I mean, so I mean that's I have even, as I said, devised new ratios if I thought that things were not getting captured. So on and so forth. So
okay, so when you say you don't really just blindly buy into conventional wisdom, if I had to ask you, are there any investors you admire whose specific traits you admire? Can you name 2, 3, if at all?
okay, now this is the other thing. I am also against, see, I mean, when you ask, and this is the way most people in the markets look at it, that so and so is successful, and what was their strategy, and therefore I must copy that strategy. First of all, I am also a person with the statistics background. This is the wrong question to ask. So the real question to ask is that of all the people who used this strategy, what was the outcome? So, for example, a very risky strategy where every year 95% of the people go bust, but the person who remains makes maybe 10 times the money. At the end of 5 years, you will find that hardly anybody is left, but whoever is left has made outsized money. But doesn't mean that following that strategy will get you there. So I have read a lot of investment literature, and you find insights here and there, and you incorporate some of them, but never swallow anyone's philosophy wholesale. First of all, many people don't even check whether what they think the investor is doing is the same thing as what that investor is doing. You look at, the most well-known one, which is Warren Buffett. People think he just buys and holds, whereas he sells almost a majority of his holdings within 6 months or 2 years. That's the kind of time range. Of all the hundreds of decisions he has taken, he says only a dozen have accounted for all his excess returns. So again, you don't look at data, you ask the wrong questions, and also account for the fact that what time period, which market did that person make money. So, that like 80s and 90s were great times for the US market, and therefore that compounding showed up for anybody who made a reasonable bet on a certain, and during that time, a certain type of companies again did well. But doesn't mean that that type of company will always do well. I mean, Ben Graham is the like the saint of value investors, but he made almost all his money in an insurance company, not in value stocks. So as I said, once you look at the data, it is different. But I mean, always, of course, feed your mind, understand your own mind. So one of the category of books I really would consider as like kind of a guru for me have been to do with understanding the fallacies of your own mind, whether it is Daniel Kahneman with Thinking Fast and Slow and Noise, or Richard Thaler's books, or there's a book called Invisible Gorilla, and many others like that. So once you have understood the numbers part properly, then also really it's very important to understand your own psychology and the pitfalls.
Oh, that's really interesting. Okay, I'm going to take off from there because you said your own psychology pitfalls. You have often spoken of things like luck, chance, affirmations, manifestation. How does it play out in your, does it play out at all in your investing universe?
First of all, in the BSc card, which was step one for me, was I think the biggest example of manifestation working out, because everyone told me not even to apply because the Brokers Club of BSc won't give you that card, but somehow every dot connected and I got that membership. So yes, I believe in affirmations. I believe in visualizing of goals. And that is, as far as luck is concerned, obviously, I mean, see, everything in life and investing very, starkly so is a game of luck and skill. Only chess is the only thing I can think of which is skill alone. I mean, the very fact where you were born accounts for so much of your life trajectory. If you were born to if your parents were landless laborers or pavement dwellers, you would not have had the life trajectory you had. And even in investing, as I said, it's a game of luck and skill, which is why every time you invest, you must tell yourself that I can be wrong because I don't know the future. So always account for that. And that is why diversification works, because that ensures, if you have the skill, that ensures that you can mathematically proven, it ensures that your skill shows up in the final results. Otherwise, when you're not diversified, you are playing only luck, which might sometimes favor you. The other thing is always, I mean, as an investor, when things go very well, you attribute it all to your skill. When things go wrong, you attribute it to that, so-and-so rigged the market, or my luck was bad, or this could not be foreseen. But in both successes and failures, there is skill and there is luck. So it is not one way.
Ah, lovely. Okay, my last question to you is, what keeps you grounded? You're incredibly successful. So what keeps you grounded?
Actually, I mean, it never occurred to me to be any other way, because for me, the money is the input and output in this business, and it's definitely a good thing to have. Nobody is saying money is not a good thing to have, but the real thrill for me is in the learning. So the real thrill, why I get up with a smile every day, is that this is one of the very few careers in the world where 30 years on, you can still say you're learning every day. You don't know it all. You can't know it all. And to me, there's nothing better than that. So, like for me, the big thrill is always getting to know something, understanding something. And now increasingly I find maybe it's my parents' genes that I also want to therefore explain it to other people that isn't it wonderful? Have you looked at it this way?
Wow, you really are passionate. It's coming across in your smile, at least. Devina, I think that's about it. And I thank you so much for your time.
Thanks, Larissa. Wonderful speaking with you.
Thank you for watching. This is Larissa for Morningstar.